What if the real shift in global power isn't happening through loud headlines about wars, elections, or tariffs, but through something far quieter, far more deliberate? While most of the world focuses on political theater, China has been methodically executing a long-term strategy that targets the foundations of modern economies themselves. Not tanks or missiles, but physical resources, the metals and materials that make technology, energy systems, and national defense possible. Over the last 10 to 15 years, China has steadily transformed vast dollar reserves into stockpiles of real assets, industrial metals, rare earth elements, and strategic materials that cannot be created by central banks. This isn't a theory or a rumor. It's visible in trade flows, government disclosures, overseas acquisitions, and corporate balance sheets. The scale is enormous. Analysts estimate that since the early 2000s, China has funneled more than $5 trillion, directly and indirectly, into securing long-term control over physical resources. While Western markets remain obsessed with quarterly earnings and financial engineering, China has focused on the real economy, the one built from copper, lithium, nickel, cobalt, silver, and rare earths. Today, we'll break down how this strategy works, why it matters far more than daily market volatility, and what it means for currencies, commodities, and preserving wealth over time. Let's zoom out. China still holds the largest foreign exchange reserves on the planet. But instead of sitting on those dollars, a growing share has been converted into hard assets. Through state-owned firms, sovereign investment vehicles, and Belt and Road projects, China has acquired mines, smelters, refineries, and processing hubs across Africa, Latin America, Australia, and Southeast Asia. They aren't just buying raw materials. They're buying control over the entire supply chain, from extraction to refinement. That's why China now dominates global processing capacity. More than 80% of rare earth refining, the majority of cobalt processing, most graphite production, and significant control over lithium and nickel. This is not short-term positioning. It's structural power. When you control refining and processing, you influence pricing, even if the raw material comes from another country. The same approach applies to base metals like copper and aluminum, where large strategic inventories exist both on official balance sheets and off-market. Now, let's look at a live case study. Silver. Silver occupies a rare position. It's both a monetary metal and a critical industrial input. More than half of global silver demand now comes from industrial use. Solar panels, electronics, electric vehicles, medical equipment, communications technology, and defense systems. And this demand isn't cyclical. It's embedded in long-term infrastructure and energy transitions. Solar manufacturing alone is on track to consume an amount of silver that rivals total annual mine production in the coming years. At the same time, supply growth is limited. New mines take many years to develop, and existing deposits are gradually declining. China has quietly been one of the largest buyers and consumers of silver, accumulating physical supply, while Western markets largely treat it as a trading vehicle. The gap between paper pricing mechanisms and physical demand has rarely been wider. When large industrial buyers step inconsistently, price discovery eventually follows physical reality. And silver is only one example of a much larger pattern. Zooming out again, we're living in a world flooded with financial claims, expanding debt, growing money supply, and rising fiscal deficits. In that environment, assets with finite physical supply naturally gain relative value. And those who control them gain leverage. Now, consider the currency angle. The dollar's reserve status has enabled decades of flexibility for U.S. policy, but has also funded persistent trade deficits through the issuance of future claims. China, long the largest holder of those claims, has been steadily redirecting dollars into tangible assets rather than relying solely on treasuries. When a major reserve holder shifts from financial assets to commodities, it places gradual pressure on currency purchasing power. Not an overnight collapse, but a slow rebalancing. Add Japan's recent move away from ultra-loose monetary policy, unwinding decades of carry trades, and capital flows are clearly changing direction. Institutions and central banks are reassessing the balance between paper assets and physical ones. So what does all this mean? We're moving from an era dominated by financial engineering toward one where control over resources defines power. Advanced technology, renewable energy, AI infrastructure, and military modernization all depend on massive material inputs. The countries that secured those inputs early gain advantages in cost, stability, and strategic independence. For individuals, the lesson is straightforward. Understand the difference between claims and ownership. Cash, bonds, and equities represent promises on future production. Physical commodities represent direct ownership of the building blocks required for that production. In a world where claims expand faster than supply, scarcity tends to win. China appears to have recognized this dynamic earlier than most. Whether Western economies adjust in time is still uncertain. But the quiet shift in control over critical resources is already happening, steadily, strategically, and largely unnoticed. If this perspective was useful, share your thoughts below and consider subscribing for deeper analysis on long-term global trends.